Hi, this is Merrill with Tax Tutor. Today we are talking about what potential changes we can see coming up under the Trump presidency. The House Ways and Means Committee has released some items, and some of them are a little shocking. There are actually tax increases included in some of those things, so we'll get into those. Like I said, I'm Merrill Taylor. I am a CPA. I've been practicing for about 20 years. We focus on helping business owners save money on taxes, specifically people making more than $500,000 or so using niche tax strategies to help them bring down their tax liability. So let's jump into this. So yes, we are looking at potential tax increases on some people. What people don't realize is that during Trump's first presidency, the 2017 Tax Cuts and Jobs Act was enacted, and the name of it says Tax Cuts and Jobs Act. So there were a lot of tax cuts in that act, in that law that came about. However, in order to finance some of those tax cuts, they had to increase taxes in some other ways. And that law made it so that business owners got a lot of deductions and people that were not business owners missed out on deductions. For example, employee expenses were completely cut. So if you were an employee, you're an employee working for someone getting a W-2, let's say you drive your car somewhere, you take someone out to lunch, you have some kind of a business expense, and your employer doesn't reimburse you for that, prior to 2017, you could claim a deduction for that on your tax return. It was subject to certain limits, and it was an itemized deduction. There was a bunch of hoops you had to jump through to get it, but the fact remains is it was deductible for certain types of people. That was completely eliminated in the 2017 Tax Cuts and Jobs Act, thereby increasing taxes for the people that were able to take that deduction previously, and those people happen to be employees, because business owners can deduct their expenses regardless of whether it's an employee type thing or not. And so that was one way that taxes were increased for employees. Another way that taxes were increased under the Tax Cuts and Jobs Act was that there was a cap put on the state and local tax deduction. So prior to the 2017 Tax Cuts and Jobs Act, you could deduct your state income taxes in full as an itemized deduction. Well, the 2017 Tax Cuts and Jobs Act needed to find ways to raise revenue, so they said, okay, we're going to cap the state and local tax deduction at $10,000. So now you could only deduct up to $10,000. Any amount over that was no longer deductible, which effectively raised taxes on people that deducted the state and local tax. Certain states, namely like New York and California, did not care for that cap at all because they are very high tax states. People in those states pay way more than $10,000 in tax, and so it effectively raised taxes on people in higher tax states. So those states came up with a workaround. They said, if you are a business owner, we'll allow you to deduct your state taxes as a business expense and then give you a credit for it on your personal tax return. The upside is that now people could then deduct their state taxes in full, again, as a business expense. The downside is it only applied to business owners. So again, the tax law benefited business owners and hurt everyone else. A third example is that that did hurt business owners, and we're starting to see that phase in now, was bonus depreciation. So in around 2017 Tax Cuts and Jobs Act, they came out with 100% bonus depreciation, which meant that a business owner could go out and buy a new asset and deduct it in full the year that it was purchased, regardless of whether the business had a net income or a net loss or a number of other things. And so they started this phase out of bonus depreciation, and as we are here now in 2025, bonus depreciation currently, as we record this video, is limited to 40%. So if a business owner goes out and buys a new asset, they can only deduct 40% of that asset through bonus, plus the first year of depreciation on that asset. Now, there is still Section 179 expense that is available. However, there's a lot of limitations on Section 179. For example, if you don't have net income from your business, you can't take a 179 expense. Whereas bonus, if you had a loss in the business, bonus could make that loss even bigger. You could take a bigger loss with bonus. And so that's one example of where business owners are starting to see their taxes go up under the 2017 Tax Cuts and Jobs Act because of this phase out of bonus depreciation, which again came in to help pay for other provisions of that tax law. So as we are now in 2025, we're looking at the expiration of the 2017 Tax Cuts and Jobs Act, and the House Ways and Means Committee is now saying, how do we extend all of these great tax deductions that we've given people? We're running out of the ways that we paid for it. We need to come up with new ways to pay for it. And Trump has now introduced a whole slew of other deductions that he wants to enact, and we'll get into some of those as we go through these. So they're saying, how do we pay for this? What are tax changes? So let's go through some of these. Number one, we've talked a little bit about that SALT deduction. It was capped at $10,000. So they said, okay, well, what if we just get rid of it altogether? What if we say state and local taxes are no longer deductible? So that's one option that they can use to save some money. They said, okay, well, what if we make the $10,000 tax cut permanent? And permanent means because right now at the end of 2025, when the 2017 Tax Cuts and Jobs Act expire, this $10,000 cap also expires. So at the moment, in 2026, we're back to being able to fully deduct state and local taxes. So they said, well, what if we make the 10K cap permanent? We just put it into law that is the new cap going forward, and we say 10K cap permanent, but maybe they double it to 20K for a married filing joint return. Because right now that 10K cap applies to everyone. Single, married, head of household, whatever status you file as, 10K is the cap for everyone. So in this example, maybe they raise it to 20K for a married filing joint. There's also a proposal to make it $15,000 for a single filer and $30,000 for a married filer. So that would be raising those caps up a little bit beyond what they are now. So that's an idea for the SALT deduction. Home mortgage interest deduction. This one is a big itemized deduction. Currently, it is limited to $750,000 in mortgage debt. So, if you bought, say, $1 million home, technically like 3/4 of that would be deductible, because you can only deduct up to $750,000 of mortgage debt for interest. And so one idea was just to eliminate the deduction altogether so that home mortgage interest is no longer deductible. Another option is just to lower that limit from $750,000 down to $500,000. So again, if you bought a $1 million home, you could only deduct half the interest rather than 3/4 of the interest. So that's another way that they're looking at raising revenue and, again, kind of increasing taxes on people. Now, some ideas that have been floated that would reduce taxes for people, and that has received a lot of press. Number one is to eliminate tax on tip income. This is actually a pro-employee one. One of the Tax Cuts and Jobs Act really didn't have any tax cuts for employees. They were mainly for business owners. So this is the first time that I've seen under Trump that we would actually see taxes be lowered on employees, and specifically on someone in probably a very lower tax bracket. When you look at people earning tips, these are typically people like servers in restaurants and people like that may not be making a lot of income, aren't really in higher tax brackets, so they would be lowering tax on people making tip income. There's also been an idea floated to eliminate tax on overtime income, and the House Ways and Means Committee report has reported both of those as potential changes in the tax law. One thing that's interesting that Trump mentioned in the campaign trail but was not mentioned in the House Ways, Means, and Committee report was the elimination of tax on Social Security income. So Trump talked about that quite a bit, but it didn't make it into this report from the House Ways and Means Committee. So I don't know what that means. I don't know if that's off the table or if that will show up in some other iteration of this report, but that has been floated, but we didn't see it in this report. Another one that is interesting, that this one would reduce taxes on people, is making auto loan interest deductible. That currently is not deductible. It had been at one point, like auto loan interest and credit card interest was deductible. I was recently listening to a book, Robert Kiyosaki, his Rich Dad, Poor Dad, and he talked about the history of taxes. And back in the day, he talked about how credit card interest was deductible and how people got into a lot of credit card debt because they could deduct the interest and things on it. So that is a potential to come in as auto loan interest being deductible. There's an idea to change the corporate tax rate. in the 2017 Tax Cuts and Jobs Act, that was a really big deal, is that the corporate tax rate went from basically 35% down to a flat 21% rate. And the House Ways and Means Committee report is reporting that maybe they can lower that down to either 20% or even drop it all the way to 15%. So that would be a benefit for corporations. These are C corporations, so we're not talking about S corporations or partnerships or things. These are C corporations, which generally are the large corporations like the Microsofts and Apple and Intuit, those really large corporations would see this reduction in corporate tax rate. Going back now, looking at ways that they're looking at increasing income tax, they're talking about eliminating the deduction of interest on student loans. So currently, when you go to school and you get a student loan and you're paying interest on that student loan, that interest is deductible on your tax return. Now, I've always found this deduction to be interesting because, yes, student loan interest is deductible. However, when your income goes above certain limits, it is no longer deductible and you get no benefit for it, which I work with a lot of doctors. I have a lot of doctor clients, and they generally have more student debt than anyone else because they go to school for an extremely long time and incur a lot of debt going to school. And then as soon as they get out of school and they start making payments on the student loans, they get their job or they go to work as a doctor and they're making a lot of money. Doctors generally make quite a bit of money, and their income automatically puts them beyond the limits of being able to deduct the student loans. So here you have a group of people who have the highest student loan debt in the United States, but yet their income puts them in a bracket where they can't even deduct that student loan. So that doesn't apply to everyone, obviously. We work with a lot of people and we see a lot of student loan interest being deducted, but that limit is pretty low. And so, I guess our client base is probably, makes more money than average. And so I don't, in my practice, I really don't see student loan interest being deductible that much. And so, but I know that applies to a lot of people out there, and that would be a tax increase on people with student loans. Then we have eliminate the credit for child and dependent care. So this is not the child tax credit that you get for having a child, which currently is $2,000 per child, or $500 per child up to the age of 17. Then when they're 17 and above, it goes to a $500 credit. That we're not talking about that one. They haven't proposed anything on that. This is the child and dependent care. So if you work, and let's say you're married and both spouses work, or you're single and just one of you work, and you pay for child care, then there is a credit that you can get on your tax return for that care. And so they're talking about eliminating that credit to help pay for some of these other, for extending the 2017 Tax Cuts and Jobs Act and creating these other tax savings and tax reduction type things. So keep in mind there. They've talked about repealing the green energy tax credits. A lot of those came about through the last administration and aren't popular with the current administration, and so I wouldn't be surprised to see some changes coming through on those green energy tax credits. Again, would increase taxes on people that were taking those credits or could have received those credits. Then there is the elimination of exclusion of interest on state and local bonds. So currently, if you were to go to your state, so as an example, I live in Utah. So let's say that I go and I buy a Utah state bond, and then that bond is going to pay me interest. Currently, under federal tax law, that interest is not taxable. And so, if I buy a bond for a certain amount of money, let's say I make $1,000 in interest on that bond, that is tax-free income to me. It comes to me tax-free. And there's state exemptions as well on that. So the federal proposal here from the House Ways and Means Committee is to eliminate that exclusion, which would mean that anyone with state and local bonds would then be paying tax on that interest. Now that's kind of an interesting thing because the interest on those bonds is lower because they recognize that you're not paying any tax on them. So people are willing to take a lower interest rate on those bonds because they know they're not going to pay tax on them. If there is a change and now they are taxable, my guess is that they're going to have to increase the interest on those bonds to make them more interesting, or to get investors to want to invest in those. Then a couple last ones here is to eliminate one of the filing statuses. There's currently 4 filing statuses. If you are married, you file either married filing jointly or married filing separate. If you are single, you file as either single or as head of household. And they are proposing getting rid of the head of household filing status. That status is really interesting because you get better tax rates than if you were filing as just single. You don't get quite as good of tax rates as if you're married filing jointly. It's somewhere in the middle of single and married filing jointly. But it does save quite a bit of tax for people that are able to use that status. So eliminating that status would definitely raise taxes on that group of people, which is probably could be a controversial move, because people that tend to fall into that status are single parents. And I don't know how popular it is to raise taxes on single parents, but that's an idea that's being floated. Then the final one here, there's lots of other ones. I'm just kind of pulling out some highlights here. So the final one we'll talk about is the elimination of some of the credits for education. There's the American Opportunity Tax Credit and the Lifetime Learning Credit. So these are credits for people going to school. They can get these credits and save money on taxes. Again, kind of like with the student loan interest, there's caps that are put on these credits. So if your income is too high, you can't get those credits. And generally, people going to school don't make much money, so they don't get the full credit. And in our case, the parents of those children make too much money to get the credits. So we don't oftentimes see these credits actually coming through on returns, but they're talking about eliminating those credits potentially to pay for the extension of the 2017 Tax Cuts and Jobs Act, or and also to enact some of these other tax cuts that they're looking at coming through. So anyway, it's going to be a very exciting year. We'll see. These again are just proposals. None of these are actual law quite yet. So we'll see how the year goes, see what happens. Make sure you subscribe, because we're going to have all these updates as we go through, as we see things, as tax laws gets passed. We'll bring updates there. And yeah, we look forward to bringing those to you.